come to question number 42 now. Alpha's investment included two subsidiaries, Beta and Gamma. The draft financial statement of financial position of the three entities on 30th September 2015 were as follows. Alpha, Beta, Gamma. Assets. Non-current asset. PPE. Intangible asset also. Investment. Only one company has investment, Alpha. Current asset, inventory, trade receivable, cash and cash equivalent, total asset, equity and liabilities, equity, share capital, underline 50 cents share. What is that 50 cent share? It means the face value is $0.50, $0.50. Retained earning, note 1 and 3. Other component of equity, note 1, 3 and 4. Total equity. Non-current liabilities. Provision. Long-term borrowing. Deferred tax. Total non-current liabilities. Current liabilities, trade and other payable. Short-term borrowing, current liabilities total, equity and liabilities total. Alpha's investment in Beta. On 1st October 2012, underline 1st October 2012. And what is that year ending date given to us? 30th September 15. So how many years are over from the date of acquisition? 3 years. 1st October 12, 30th September 15. 3 years are over. So that may be required at some places for calculation of depreciation or amortization. Alpha acquired 300 million shares in Beta. How many shares are there in Beta total? 4 lakh. 4 lakh and 400,000 and 300,000. So 75%. 300 million out of 400 million is 75%. So in Beta, Alpha is holding 75% share. By means of a share exchange of one share in Alpha for every 2 shares in Beta. So 1 by 2 into 300. These many shares they have issued. On 1st October 2012, the market value of an Alpha share was 2.40 into 2.40. So what should be the fair value of the shares issued? Fair value of the shares issued 1 by 2 into 300 into 2.40. 360? Is it 360? 1 by 2 into 300 into 2.40. 360 you have paid in the form of shares only and something more. Alpha incurred directly attributable cost of 2 million on acquisition of Beta. So this 2 million we will transfer to P&L account. This cost comprised of, so what they have done with this 2 million, 0.8 million cost of issuing own share. Cost of issuing own share debited to Alpha's share premium account within other component of equity. Right. So this is a right treatment. Cost for issue of share will be adjusted in other component of equity. 1.2 million due diligence cost. Oh. Included in the carrying amount of investment in Beta and Alpha's own statement of financial position, right? Wrong. So 1.2 million we will charge to retained earning. Retained earning will reduce by 1.2 million. Okay. This is wrong. Cost incurred for acquisition will be charged to P&L account. Cost for issue of own equity instruments will be adjusted in equity. So there has been no change to the carrying amount of investment in Alpha's own statement of financial position since 1st October 2012. On 1st October 12, the individual financial statement showed the following reserve: retained earning 125 million, other component of equity 10 million. So this you will write in pre-acquisition, that is 1st October 12 column. Directors of Alpha carried out a fair value exercise to measure the identifiable assets and liabilities of Beta at 1st October 2012. The following matters emerged. Plant and equipment having a carrying value of 295 million had an estimated market value of 340 million. So what is the increase in the value of plant and equipment? 340 minus 295. 45 million. The estimated useful life is 5 years. Divide by 5. 3 years are over. Into 3. 27,000 additional depreciation we will charge. Okay. Next line. None of this plant and equipment had been disposed of. So this plant and equipment still exist on 30th September 15 also. And in process research and development project existed on 1st October 2012 but did not meet the recognition criteria of IS 38 intangible asset. The fair value of the research and development project on 1st October 12 was 20 million. So this we will add in intangible asset, 20 million. Okay. Because from the point of view of the acquirer, this has a value. Research and development project. In the books of the acquiree, it may not be treated as an intangible asset, but for the acquirer, it has a value. Okay. So this project started to generate economic benefit on 1st October 13. So we will depreciate from 1st October 13. And our year ending date is 30th September 15. So 2 years are over. 20 divided by 4 into 2 is the amortization of this intangible asset. 10. The above two fair value adjustments have not been reflected in the individual financial statement of Beta. In the CFS, this fair value adjustment will be regarded as temporary difference for the purpose of computing deferred tax. Same adjustment we have done earlier also. The rate of deferred tax to apply is 20%. Alpha uses, underline, proportion of net asset method. Alpha uses proportion of net asset method to calculate NCI in Beta. So while calculating the NCI, first I have to find out what is the net asset of Beta on the date of acquisition. And they are not going to share goodwill impairment, if any. Okay. And that is why they have given note number 2. They want to test your knowledge of goodwill impairment when NCI is measured using proportionate share in net asset. So note number 2, impairment review of goodwill on acquisition of Beta. No impairment of the goodwill on acquisition of Beta was evident when reviews were carried out on 30th September 13 and 30th September 14. On 30th September 15, the directors of Alpha concluded that the recoverable amount of the net asset, including the goodwill, recoverable amount of the net asset underlying including the goodwill of beta at that date was 450 million. So in this problem we have to also calculate first impairment loss. Okay, and then we have to allocate that impairment loss. Beta is regarded as a single cash generating unit for the purpose of measuring the goodwill impairment. Note number 3, alpha's investment in gamma. So this I will discuss when we will come to that point. It has a lot of adjustment involved, this impairment of goodwill, because proportionate share of net asset method is used. Note number 3, alpha's investment in gamma. On 1st October 14, underline 1st October 14 means at the beginning of this financial year. Yes or no? So for the entire year it will be treated as post acquisition. Alpha acquired 144 million share. So first let us check percentage. How many total shares are there in balance sheet? 240. 144 divide by 240. 60%. So write in bracket aspas 60%. Nearby write down 60% share. By means of a cash payment of 125 million, Alpha incurred cost of $1 million associated with these purchases and debited this cost to administration expenses, tick mark right, in its draft statement of P&L account for the year ended 30th September 15. There has been no change in the carrying amount of this investment in the financial statement since 1st October 14. Very good. On 1st October 14, the individual financial statement of gamma showed the following reserve: retained earning, other component of equity. So this you will write on 1st October 14 column. On 1st October 14, the fair value of the net asset of gamma were the same as their carrying amount with the exception of some land. So there is a land which needs revaluation, which had a carrying amount of $100 million and a fair value of 130 million. So this 30 million we will write in 1st October 14 column, date of acquisition column 30. This land continued to be an asset of gamma on 30th September 15. Fair value adjustment has not been reflected in the individual financial statement of gamma. In the CFS, the fair value adjustment will be regarded as a temporary difference for the purpose of computing the deferred tax. The rate of deferred tax to apply to temporary difference is 20%. There was no impairment of goodwill arising on acquisition of gamma. So here there is no goodwill impairment in the CFS on 30th September 15. Alpha uses the proportion of net asset method to calculate NCI in gamma. So in this question, the student will have to find out what is the NCI on the date of acquisition. And for that he must find out what is the net asset on the date of acquisition carefully. Is it right? So note number 4, apart from its investment in beta and gamma, the investment in alpha included in the statement of financial position at 30th September 15 are all financial asset which alpha measures at fair value through OCI. These other investments are correctly measured in accordance with IFRS 9 financial instrument. Which means, dear student, you have to find out what is the amount of other investment in the financial statement. So total investment minus investment in beta minus investment in gamma, that you have to find out. 10.8 million. 10.8 million is right. Next line. Intra-group sale of inventory. The inventory of alpha, inventory of alpha and gamma. Alpha is the parent company, gamma is another subsidiary. At 30th September 15 included component purchase from beta. Okay. In the last 3 months of the financial year at a cost of $20 million. Who made the profit? Beta. So we will eliminate from beta's profit to alpha and 16 million to gamma. Beta supplied these goods to both alpha and gamma at a markup of 25% on the cost to beta. So 25 by 125 of sales price we will take for elimination of unrealized profit. Is it right? Okay. Now here you see there is no adjustment for deferred tax mentioned. Ignore. If that paragraph does not mention about deferred taxation, ignore it. And it is written below. Point number 6, trade payable and receivable. Group policies to clear intra-group balances on a given date prior to each year end. All group companies had complied with this policy at 30th September 15. So at that date, there were no outstanding intra-group balances. So they could have avoided this note only. No adjustment right down. Unnecessary terror to the student. Okay. Point number 7. Provision. On 30th September 15, Alpha finalized the construction of an energy generating facility. Now here your IS 16 will be applicable. What is that? Property, plant and equipment standard. The facility has an expected useful economic life of 25 years and Alpha has a legal requirement to decommission the facility at the end of its estimated useful life. So you need to calculate the provision, present value of decommissioning liability. The directors of Alpha estimated the cost of this decommissioning to be 34 million based on the price prevailing at 30th September 2040 at an appropriate discount rate. The present value of the decommissioning facility is 10 million. The directors of Alpha made a provision of 34 million. Is it right? And charge this amount as an operating cost in the financial statement of Alpha. So what are the implications? In the balance sheet, provision will be reduced by 24 because I want to keep only 10 right now. Then PPE will increase by 10 because this provision for decommissioning liability will be added to PPE cost. And then retained earning, no interest because it is 30th September 15. So interest adjustment in this problem is not there. Good news. Okay. This 34 which you have charged to retained earning is totally wrong. Is it right? So journal entry, if you want to see, provision account debit 24, PPE account debit 10, to retained earning 34. So in retained earning you add, in PPE you add this number, and in provision you deduct 24. Is it right? Which standard discusses about this treatment? IS 16. Note number 8. Long-term borrowing. On 1st October 2014, Alpha issued $40 million one bonds at par. The cost of issuing the bond is $1 million, and this cost was charged as a finance cost for year ended 30th September 15. Is it right or wrong? Wrong. Because all issue expenses are adjusted in the carrying amount of financial liability. So financial liability would have become 40 minus 1, 39 million. Okay. So we are going to reverse this 1 million they have charged in the retained earning. The cost of issuing the bond was 1 million, and this cost was charged as a finance cost for year ended 30th September 2015. No interest is payable on the bond, but they are redeemable at a large premium, which makes their effective finance cost at 8% per annum. So now what I have to do, I have to pass entry for effective interest in P&L account, which will be 8% of 39 million. How much is 8% of 39 million? 3120. But you have already provided 1000 wrongly. So what I'll do, I need to provide 2120 more. Or either you reverse this and you can do this plus and this minus in retained earning. And what about the carrying amount of the loan liability now? Carrying amount of the loan liability 39,000 plus 21 plus 3120. This effective interest will be added in the carrying amount so that it becomes equal to maturity value on maturity date. But your balance sheet shows right now how much? Your balance sheet shows the liability at 40 million. Your balance sheet shows the liability at 40 million. So I need to increase the carrying amount of the liability. Okay. I have to reduce it by 1000 and I have to increase it by 3120. So my effective journal entry will be long-term borrowing account debit 2120. Sorry, reverse. Retained earning account debit 2120 to long-term borrowing 2120. Okay. 2120 add in long-term borrowing and 2120 reduce from retained earning. Question is A. Prepare the consolidated statement of financial position of Alpha on 30th September 2015. You need only consider the deferred tax implication of any adjustments you make where the question specifically refers to deferred tax. Like for example, in property, plant, equipment revaluation they have mentioned. But for intra-group sale of inventory, they have not mentioned. So what is not mentioned, ignore. Okay. Then there is another question. On 15 November 2015, Alpha purchased shares in Theta. My God, more Theta. But that is after the end of that. This is only a theory question, don't worry. In Theta, which gave Alpha 45% shareholding in Theta, on the same date, Alpha purchased an option which gave Alpha the right to acquire an additional 10% of the share in Theta from the existing shareholders. This option is exercisable at any time between 15 November 2015 and 30th September 17 at a price which makes it highly likely the option will be exercised during this period. That means potential voting rights will also be considered. So 45% plus 10% will make it 55%. The directors of Alpha are unsure how to treat Theta in the CFS for the year ended 30th September 2016. So one line answer, it will also be treated as subsidiary. Is it right? So now we will start this wonderful question. So first you come to Consolidated Statement of Financial Position, PPE. Right now only tick mark 3 items. 3,80,000, 3,55,000 and 1,52,000. Intangible asset right now tick mark 80,000, 40,000, 20,000. Investment, I have to go to working note 8. In working note 8, investment figure as per Alpha's statement of financial position, 4,97,000, and deduct investment to be eliminated on consolidation. Shares issued to acquire beta. What was the value of shares issued to acquire beta? 3,60,000. And this also includes the due diligence cost. So that due diligence cost is also to be removed. How much is that due diligence cost? 1,200. Then cash paid to acquire gamma. How much was paid to acquire gamma? 1,25,000. So which means the remaining investment 10,800. So this you transfer to balance sheet. This you write in cost of acquisition in goodwill working, and this you transfer to retained earning, write off in retained earning. This also you write in cost of acquisition. So at 4 places we'll have to write these numbers. So let us start with balance sheet. Balance sheet you write investment. How much you said? 10,800. Then we'll go to goodwill working. Cost of investment, shares issued to beta, 3,60,000. Cash paid to gamma, 1,25,000. And then we also come to retained earning. Adjustment for acquisition cost of beta, in bracket write 1,200. Okay, up to this is okay? Say yes. Dear student, come to next item. This is inventory, trade receivable, cash and cash equivalent. Just keep ticking mark 3 numbers. Tick, 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 3 numbers. In inventory there is an adjustment, we'll take later. Tick mark. Trade receivable tick mark, but take total also, because there is no further adjustment. Anybody? Total 1,96,000. Cash and cash equivalent, take total 35,000. Equity and liabilities, share capital. Parent company share capital will come in the balance sheet. You have to check whether this issue of share has already been incorporated in balance sheet or not. Yes. So write down as it is 1,50,000. If it is not incorporated, like the previous problem, then you will have to add. Then what about the retained earning of the parent? Come to working note 6. Retained earning 4,98,000. And other component of equity, working note 7, 2,95,000. 2,95,000. Okay. Then subsidiary. Subsidiary number 1, beta. Come to working note 1. Share capital 2 lakh. Share capital on both the dates 2 lakh. Now wait a minute. Retained earning on the date of acquisition. It is given in the note number 1, 1,25,000. 125,000. And what is appearing in the balance sheet? 1,86,000. Wait a minute. And what about other component of equity? It was 10,000 earlier, and now also 10,000. So right somewhere below I have written the heading 10,000. So which means whatever change that will happen will only be adjusted in retained earning. Okay, now let us go to working note 2, share capital 1,20,000. 1,20,000. Retained earning. What was retained earning on the acquisition date? Is it given 45? 45. And how much is now in the balance sheet? 60,000. Other component of equity on the date of acquisition, was it 2 million? In the fourth line, 2 million. And now also 2 million. Done. So now your speed has increased substantially. Yes or no? Provision. What is the entry for provision we have decided? Provision 34,000 is appearing, but it should be only 10,000. Is it right? So provision we will reduce by 24,000. So come to provision in the balance sheet. Write directly here 10,000 only. Non-current liability. Then you will add 10,000 in the PPE. Provision account debit 24,000, PPE account debit 10,000. So tick mark 10,000 provision. And retained earning account credit 24,000, because this is wrongly transferred to 34,000. So I'll just repeat the journal entry I have passed. Provision account debit 24,000. PPE account debit 10,000. To retained earning 34,000. Now come to long-term borrowing. First to just come to balance sheet and tick mark these three numbers. Long-term borrowing. Deferred taxation. Working note 9. Go to working note 9. What is the total of these three items? Deferred taxation, is it 90,000? Just write here 90,000. And then once we complete working note 1 and 2, we'll get the closing balances of these two subsidiaries. Okay. So total non-current liabilities. Now we have current liability. Trade and other payable. We come to balance sheet. Add trade and other payable. There is no adjustment. How much it comes to? 1,40,000. Short-term borrowing. Add 50,000. Total current liability. You can write this also, 1,90,000. This completes my SOFP items. And then note number 1, whatever we have done, we will not discuss that again. On 1st October 2012, Alpha acquired 300 million shares in Beta by means of a share exchange of one share in Alpha for 2 shares in Beta. On 1st October 2012, market value of Alpha share was $2.40. Alpha incurred directly attributable cost of $2 million on acquisition of Beta. This all we have done. Then 0.8 million was for issue of share. This is right, no adjustment required. 1.2 million due diligence cost, wrong, rectified. We have rectified. Next line. There has been no change in the carrying amount of this investment in Alpha's own SOFP. No adjustment required. On 1st October 12, the financial statement of Beta showed the following reserve. Done. Directors of Alpha carried out a fair value exercise to measure the identifiable assets and liabilities of Beta on 1st October 12. The following matters emerged. Plant and equipment having a carrying amount of 295 million had an estimated value of 340 million. The life of the plant is 5 years. None of this plant and equipment had been disposed. So on the screen, working note 1. Plant fair value adjustment, how much will I write? Left side, working note 1. 340 minus 295. So 45,000. 45,000. And extra depreciation due to fair value adjustment, 45,000 divided by 5. 3 years are over, into 3 by 5. In bracket write 27,000. Deferred tax adjustment later. Next line. An in-house research and development project existed on 1st October 12 but did not meet the recognition criteria of IAS 38. It did not meet in the acquirer's book because they may not have financial feasibility. But now this is an acquirer, big company. So they may treat this as a financially feasible, technically feasible project. The fair value of the R&D project on 1st October 12 was 20 million. So write down here research project fair value adjustment. 20 million. And then amortization in the next line. Amortization will begin from 1st October 2013 when it is available for use. So 20,000 divided by 4 years useful life into 2 completed years. How much? Is it 10,000? Now wait, we have to also write these items. 45,000 minus 27,000. So how much? 18,000. An intangible asset 20,000 minus 10,000. 10,000. 18,000 and 10,000. You see here on the screen. This 18,000 is 45 minus 27. And this 10,000 intangible asset is 20 minus 10. So can you now complete the intangible asset in the outer column? 80, 40, 20, 10. 1 lakh? 55. Okay, okay. But this a non-current asset, one figure we have to, yes, we have to check. So wait, don't take total. Next item in the question, temporary difference, but that I will do little later because some more figures are yet to be completed. That is not there, but first we'll finish up to this. Once we are sure that this table is over, then we'll go to the last three line. Okay, wait a minute. Next point number 2, impairment review of goodwill. Write down pending. This will do later because for that I require net asset on the 30th September. For computing the impairment loss, I require carrying amount of this entire subsidiary. The subsidiary itself is a CGU. Okay. So note number 2 we'll discuss towards the end. Pending. Note number 3. Alpha's investment in Gamma. On 1st October 14, Alpha acquired 144 million share in Gamma by means of a cash payment of 125 million. Done. Alpha incurred a cost of 1 million associated with this purchase, debited to administration expense. Right. No adjustment required. There was no change in the carrying amount of this investment. Very good. On 1st October 14, the individual statement of Gamma showed falling reserve. Done. On 1/10/14, the fair value of Gamma were same as carrying amount exception land, whose carrying amount is 100, fair value is 130. The land continued as an asset till 30th September 15. Fair value adjustment has not been reflected. In CFS, this adjustment has to be done. You have to give the deferred tax implication at 20%. No impairment of goodwill. So now come to working note 2. For this entire paragraph, you have to do only one thing. Two things. Land adjustment. How much will you write? 30,000. So go to balance sheet also. In balance sheet, this 30,000, can you see it is written here? And working note 2 is also written. Tick mark. Now you see all numbers we have written. Tell me the total of PPE. Correctly. Total of PPE. Come fast. Is it 9,45,000? Very good. Okay. Alpha uses the proportion of net asset method to calculate NCI in Gamma. So that we will do together once both working note 1 and 2 are over. Dear student, come to other investment. Done. Other investment we have done. Intra-group sale of inventory. This time who has sold? Beta. So come to Beta's 30th September 2015 column. What is the sale made to Alpha? 20 million and to Gamma 16. So can I say together 36,000 inventory are lying in the group, which includes profit? 20 plus 16, 36. The margin is 25% on cost. 1/4 of cost is 1/5 of selling price. So tell me 1/5 of 36,000. 7,000 in bracket. Now second effect of this will give in balance sheet. Inventory. Can you see 7,200 is written here? Yes. Now tell me the final inventory figure in the outer column. 227. Very good. 227,800. Okay. Trade receivable and payable, we don't have to do anything. Provision adjustment we have done. Do you remember provision we have done? Now come to long-term borrowing. For that, you come to this retained earning working note. In this retained earning working note, fourth line on the screen, adjustment for finance cost on zero coupon bond. Because this bond does not specifically pay any coupon, but it will be redeemed at a premium. Effective rate is 8%. So this company should have charged, see on the screen, it should have charged 8% of 39,000, which we had discussed at that time. How much was that amount? 8% of 39,000? 3120. This is what they should have charged. But what these people have done, only that issue expenses 1,000 have charged. So there is a short charging of finance cost. How much is that short amount? 2,000 something? 2120. 2120 negative. And now we'll come to the balance sheet also. Long-term borrowing will have a net incremental effect of 2120. Reduce by 1,000, add by 3120. Reduce by 1,000 because there is an issue expense, and add the accrued interest 3120. So tick mark 2120 also. Now tell me the final long-term borrowing in the outer column. 157. Very good. 157, 120. Okay. So now we will close this question line by line carefully. First you come to net asset table and deferred tax adjustment. Understand, I'm going to highlight some numbers and only on that the deferred tax adjustment will be done. On this unrealized profit, deferred tax adjustment is not to be done. So take 45,000 plus 20,000, 65,000. 65,000 into 20%, 13,000. So write here 13,000, positive or negative? It will be deferred tax liability because in assets carrying amount has gone up, tax base has not gone up. Now similarly over here, take the net total of these four items which I have put in a small box. 45 minus 27 plus 20 minus 10,000. 45 minus 27 plus 20 minus 10. They have not asked us to calculate DTA or DTL on inventory. So anybody wants to volunteer an answer? 5,000? Huh. See, you should write the calculation also yourself in case if you think you will forget. Okay. Now you can take the total of net asset. Take total of net asset. 1st October column. $3,87,000. Take total of this last column also. $411,200. Okay, wait. Come to this working note also. First, I will write deferred tax implication. Deferred tax implication will be because of this land adjustment. 30,000 into 20%. How much is that? 6,000? 30,000. It's written here also. 6,000. 6,000. Now tell me net asset on 1st October 14. Total of 1st October 14. Add this 4, 5, 1 lakh? No, 1 lakh something. 1,91,000. Next one. Next column. 2,06,000. Now wait for a minute. Now there are a lot of adjustments arising out of it. So 2,06,000 write down. 2,06,000 last column. 206,000. Now dear student, first we will write these two deferred tax figure in that working note on deferred tax. Closing deferred tax 5,600 here and 6,000 here. Can you see this? 5,600 and 6,000. Go to that working note number 9. $5,600 and 6,000. So this is the total. Now this is also DTL. This is also DTL. And the opening balance is also a liability. So it will be added. It will be added. So final figure is 1,01,600. Is it right? Say yes. 1,01,600 in balance sheet. Now we'll come back to working note 1. See this number. 3,87,000 is net asset on the date of acquisition. And this 1,91,000 gamma net asset on the date of acquisition. So we'll use it for goodwill calculation. Working note number 3. Net asset at the date of acquisition here on the screen. 3,87,000 and 1,91,000. Using this number, compute the NCI also here. Take 25% of 3,87,000. Is it 96,000? Very good. Take 40% of 1,91,000. Yes. So what is goodwill before impairment? Impairment is pending. So you first take 3,60,000 plus 96,750 minus 3,87,000. So this will give you goodwill, beta column. Goodwill beta. 69750. Very good. Goodwill gamma 10,400. Now we don't transfer it to balance sheet because some impairment is pending. Okay. Let us come to non-controlling interest. Non-controlling interest. Proportion of net asset method. So first you write down the closing net asset on 30th September. What is the closing net asset on 30th September 2015? Working note 1. Closing, second column. 411,200. This is a shortcut because their share is proportionate share in the net asset. There are two ways you can reach this magic number. You can take opening balance and then change in the post acquisition, or directly take post total of the post acquisition net asset and into their respective share. What is Gamma's net asset on 30th September? Working note 2, second column. 2,06,000. Right here, 2,06,000. If you can understand by this method, it is fast. If it is proportionate share in net asset method, so at the end of the year also they will get a proportionate share in the net asset. 25%. Come on. 82, 400. 25% is 1 lakh something. Okay, second column. Second column is 82. Acha, second column. No problem. Total I have written below for you. 185, 200. This figure you lock. This you write in balance sheet. In balance sheet, where is NCI? Here. And how much is the total? You said 185, 200. NCI is over. 185, 200. Okay. So now what is pending? Impairment of goodwill is pending. Working note number 4 is pending. Then non-controlling interest is over. Other component of equity, in both cases there is no change. Neither beta nor gamma has any post-acquisition other component of equity. Yes or no? So nil write down. So what is this figure? 2,95,000. It will remain 2,95,000. This figure also you lock and transfer to main page. 2,95,000 other component of equity. 2,95,000. First you write a note for goodwill impairment. All of you write a note. Write a note. Stop other activities. Note on goodwill impairment. Note on goodwill impairment. Just 2-3 lines. Goodwill attributable to NCI. Goodwill attributable to NCI is included. Goodwill attributable to NCI is included in the recoverable amount. In the recoverable amount of $450 million. In the recoverable amount of $450 million. But has not been recognized. In parent's CFS. But has not been recognized in parent's CFS. Therefore, the carrying amount of subsidiary. Therefore, the carrying amount of subsidiary should be grossed up. Carrying amount of subsidiary should be grossed up. To include. Should be grossed up to include goodwill attributable to NCI before being compared with recoverable amount. Before being compared with recoverable amount. Before being compared with recoverable amount. Now let us read adjustment number 2. Once again, read adjustment number 2. Please keep note 2 in front of you. No impairment of the goodwill on acquisition of beta was evident when reviews were carried out in 2013 and 14. On 30th September 15, the directors of Alpha concluded that recoverable amount of the net asset, including goodwill, of beta at that date was 450 million. Beta is regarded as a single cash generating unit for the purpose of measuring the goodwill impairment. Okay. So with that background and this note, let us come to working note 4. In working note 4, how to compute impairment loss you have learned. You will add carrying amount plus goodwill and compare with the recoverable amount. Is it right? So what is the carrying amount of net asset of beta at the end of the year as per working note 1? Anybody wants to tell me that figure? This figure. 411, this figure. 200. The whole subsidiary is a CGU. The carrying amount of this CGU is 4,11,200. So right here 4,11,200 as per working note 1. Now you are given recoverable amount of beta including goodwill, which is 450 million. So in order to make these two numbers comparable, we will also temporarily assume goodwill of NCI also. Of course, that we will not consider in the final answer. But to make the two numbers comparable, we'll take full goodwill. So grossed up goodwill on acquisition, 69,750 we have calculated. This number 69,750. Okay. Divide by 75%. Divide by 75%. So how much is that? 69,750 divided by 75%. 93,000. 93,000. So my total becomes 5,04,200. Carrying amount is more than recoverable amount of beta as a CGU. So gross impairment loss is 54,200. But out of that, now we'll again take 75% only, our share. NCI share we will not allocate to NCI because NCI does not include goodwill. But our share only will adjust. So how much is 75%? 4625? 40650. Wait. 40650. So in case of proportionate method, if the recoverable amount is given including the goodwill, first you find out the gross goodwill compared. Now this goodwill, this impairment loss, can it be fully allocated to goodwill or should it be allocated to goodwill and asset? Goodwill. Is it sufficient to absorb this entire impairment loss? Yes. So come back to working note 3. waiting for you. Impairment of beta goodwill. Right here 40650 in bracket dash. So balance goodwill is how much left here? 29,100 and this is 10,400. Total goodwill 39,500. Write in balance sheet. Goodwill working note 3 39,500. Okay. Now which working note is pending? Retained earning. In retained earning, two adjustments are pending. One is share in the post acquisition retained earning of the two subsidiaries. Okay. Go to working note 1. What is the increase in the retained earning of the subsidiary beta? Is it 24,200? See working note 1 into 75%. 18 gamma. What is the change in gamma's net asset? 15,000 into 60%. And what is impairment of goodwill? 40. Okay. Now tell me the total. 515. Okay. 515180. Is it matching? Everybody. Come to balance sheet. 515180. Tell me the total of the asset side, those who have done. 16,04,000. Okay. Tell me the liability side total. Amazing. In one attempt only you are able to tally. 16,04,100. Okay, now we'll continue tomorrow.